we're all here. So I just first want to say thanks to Jennifer and John from One Day in July, who is bringing us a topic that couldn't be more timely given how volatile things are in the world right now and how we're grappling with these inflationary times. Uh, the timing is just perfect. So I think we should probably start with a round of introductions so that everyone knows who's in the room. I am Vince Jackson, Executive Director of the Greater Northampton Chamber of Commerce. And I'm gonna pass it on to you, Katie, to introduce yourself.
Hi, I'm Katie McLaughlin. I'm the Senior Manager of Investor and Community Relations at the Chamber of Commerce. I'm going to hand it on over to Ella.
Afternoon, my name is Ella Elkavich. I run and own Ella Elk and Nook in Northampton, and I'm on the chamber board.
I'm Jack Brown. I'm marketing director here at the Chamber and very new to saving for the future. So I'm excited to see what we can talk about today.
My name is Mark Moggio. I'm here and I'm actually part of the Northampton Lions Club, which is part of your organization, the Chamber.
Thank you, Mark. And so Jennifer and John, you can introduce yourselves.
All right. My name is John Bass. I work in our Northampton location. The firm I work for is One Day in July. We're an investment advisory firm. That firm is located in Burlington, Vermont. We have mainly a regional physical presence, but clients all over the country. And the whole goal of the firm is to reduce costs, simplify and increase transparency in portfolios, and try to operate in the best way for the clients overall. So I'll turn it over to Jen now.
Hello, thanks for having me. I work in our Burlington office. I support two of our advisors, and I'm here just to assist John with the presentation today. And I really do care about helping empower people to take control of their own investments. So I do some of these presentations as well at my local library, and I'm happy to be here.
All right. Well, with that, I'll go ahead and begin. Today's presentation is about what's draining your portfolio, quite literally. And we wanted to focus on things that are in your control. These are things that are basic overarching things that you can improve to make sure that your portfolio grows most efficiently for you. So we'll go ahead and go to the second slide. And we're going to just begin with, setting a foundation here on what does it mean to invest. We're speaking about putting your money to work over time. So it's, savings for long-term purposes. Maybe it's for retirement, for saving for a particular goal, whatever that is. But having that plan put to work over time so that you can increase your wealth over time. And specifically, we're talking about equities and bonds, sort of the primary components of a portfolio. Okay. All right. So these are the things that are in your control, but they're also the things that drain your portfolio. And they are behavior, asset allocation, and fees. And so these are the three main components. There's certainly other things that can impact a portfolio, but if each and every one of us were to focus on these things predominantly, this would be 99% of what would really move the needle for you in terms of improving your portfolio over time. Okay, so we're going to start off with your behavior. And you'll see here, Mr. Ben Franklin is giving everybody a slightly judgy, intense look. This individual is basically telling you to watch your behavior, and we're going to get into the aspects of behavior and why that part is so important. We all suffer from this as humans. These are the things that are sort of emotional controls and how we act over time as it relates to our money. All right, we'll go to the next slide here. So the largest variable is in fact you. It's the decisions you make. It's your behavior along the way in terms of saving and investing in the choices you make. One of the things I think super important when you start off is identifying what's your why. Why are you saving money? What is it for? Is it to invest for retirement? Is it for your kid's college education? There's any number of things that you might have as goals, but the key thing is if you don't know why, you're more apt to make mistakes. If you have a clear understanding of what you're doing with your money, you're naturally going to be more in tune to that, and you're going to pay attention to the things you need to do to make it work for you. Okay.
I would add here, John, if you don't mind, that knowing
Sure.
your why also helps with trade-offs. So inevitably with our money, there's trade-offs. So we can decide, on something as simple as like a fancy lunch versus not, and have that money for something else. And we can also make decisions on whether to fully fund our retirement one year versus go on vacation, or to pay off our mortgage versus, adding more to our brokerage account. And those are all personal decisions. And ultimately, you are the boss of your money. So, a financial advisor can help, but understanding your why and your motivation can help you direct where your dollars should go. The other thing that I find it can be helpful with is giving yourself some grace for previous choices. So, okay, maybe at that point in my life, okay, I wish I would have done this, this, and this. But at that point in my life, something else was really important to me, and it is what it is. But it helps you to be able to sort of, see things in a context that can be helpful to you with trade-offs and with your money decisions.
Yep. Thank you. All right, we'll go to the next slide, which we call Pay Yourself First. Pay Yourself First is just a very simple concept, and it's really about starting with you, right, as it suggests. So in our lives, we have any number of things we have to pay for, daily expenses, big expenses, surprise expenses, you name it. But in terms of saving and investing for the long term, at the very least, when you think about all these things you might be spending money on, even the trivial things, right? Like we all have who knows how many streaming services we pay for that we've already lost track of. We don't know, what that number is now. But at the very least, if you pay yourself first, meaning in your budget, if you've identified, even $100 a month that you can set aside towards a retirement account, and you, before anything else you do, you have paid yourself first, you are putting that money to productive use, and it's going to grow over time. And it will become part of your savings habit. You won't miss it, and you're more apt to stick to that program over time. And that really, long term, is a primary determinant in how you do, is saving early and saving often. Okay. And this next slide really shows you that effect over time. Okay. And what this slide is showing you is, if you had a goal to save $1 million by age 65, and, in a particular set of investments, they're going to grow at a rate of return, and you start at age 25, you would only have to put away $400 a month. But if you delay, and this is the key thing, if you delay to age 30, age 40, or perhaps even age 50, the amount per month you have to put in to reach that goal at 65 grows exponentially. You can see this. And this is really related to compounding. Time is your friend. So the earlier you start, the better, but it's never too late to start. Never too late to start. You always want to capture the remaining time you have in terms of contributing to your accounts. Okay, so this next slide talks about some investing behaviors. And again, as humans, we all have these behaviors. These are just part of who we are. And it's important to know about them, recognize them, so that we are less apt to do these things. Confirmation bias is a huge one. And this is where we all, you might have done this yourself. We certainly all have at some point, or you hear a friend or someone who says, I've done my research. I've done my research on this thing. Generally speaking, what we do when we commit confirmation bias is we have a pre-held belief that we are searching evidence to support, right? And so whether it's news, whether it's investment research, whether it's an opinion on anything, you have something that you want to confirm, you find the thing that confirms it, and then you run with that. And then unfortunately, you may have selectively ignored a bunch of other things that ought to be part of this analysis, but you've already put those in sort of your blind spot. This is a big problem in investing. Overconfidence bias is another one. At the risk of generalizing here, and I hope I don't insult the audience, I'll throw myself under the bus. Overconfidence bias is a big problem with men in general in investing. We tend to think we're correct, and we can be too aggressive in that assessment sometimes. And that's nothing more than diving headfirst into something, feeling like you got it before you've really considered if you do or you don't. Market timing is where throughout your investment lifetime, in the ebbs and flows of the market, you might try to jump in and out of the market, thinking that you can appropriately time all these up and down moves. This has been shown to be next to impossible. It is impossible. And it is a behavior where we're seeking control. It gives us the feeling that we can control things in the absence of control. I mean, so in terms of this, these last two, timing the market and then stock picking and concentration risk, these are really sort of symptoms of behaviors. And then in that last one, stock picking is an effort to try to find individual stocks that might beat an index. This typically leads people to really over-concentrate in dangerous areas of the market. Maybe a handful of stocks make up the most of your portfolio. So you take on a lot of risk without really knowing it, and you can potentially really damage a portfolio that way. Okay. The next slide here, cycles of emotion. This is quite an interesting one to me because it really overlays with the market. And so for those of you all who've been around long enough and remember in your investment lifetime can remember the global financial crisis, you can imagine 2007, say March of 2007 or mid 2007 to be the euphoria stage. Okay, that's when everybody's extremely happy about being in the market, right about the time it's peaking. And we only know these things in hindsight. And then as you go through market drawdown, you'll see things start to pick up: denial, anxiety, fear. And then it's not until you really get far into a large market correction where you start to see this sort of capitulation, despondency phase, where it's people are, oh, I've had enough of the stock market, I'm done, I want to get out. And they sell at the bottom. They sell at the point of maximum opportunity, the point where they should be buying and doubling down and contributing more, they're selling out. So these cycles of emotion really force us to do the opposite action that we should be doing. You all are familiar with Warren Buffett. He's quite amazing at doing the proper things, doing the exact opposite of what most people do through these cycles of emotion. On the next slide, we show the difference in market activity over days versus decades. And as investors, which, this is what we're gearing this towards, we're not talking to high frequency traders or day traders or anything like that. And I personally believe that most people should never try to do any of that. Market action over days is noise. It is random movements up and down, high volatility, guessing direction on any given day, hour or minute is extremely difficult. And so it's just basically like white noise on an old television set on static, right? You're not quite sure what the direction is. Decades is a growth line where if you were to expand broaden your view from days to weeks to months to decades, you'll see all this volatility wash out. And if you look at a really, really long-term chart of, say, a broad market index like the S&P 500 index, you'll see some bumps in the road. But if you look at a decades-long scale, you'll just see a nice long trend line up over time as that index grows with earnings growth. So the goal here is, as an investor, you really need to decide what you want to focus on. Do you want to let short-term volatility dictate your actions, or do you want to focus on the long term? All right. And this next slide is a example of why this is important. And so what this is showing you here is the chance of returns being negative for different holding periods. So if you look at a one-day holding period and you were invested in the S&P 500 index, you would have about a coin toss chance that you were going to have positive or negative returns. Okay? A month, it's a little better. A quarter, a little better. And then if you look at it 5 years, only a 10% chance that rolling 5-year periods will have overall negative returns. 10-year periods at 6% chance. And then as you get out 20, 30, 40 years, that goes down to essentially zero. And so the takeaway here is you want to be a long-term investor to capture market returns. There's a saying I tell my clients or prospective clients that volatility is the price of admission for seeking higher expected returns. So it's nothing to be feared, but it's something to understand. Okay. We're going to move on to the next segment, which is asset allocation. And asset allocation is just the components of what makes up a portfolio. And, we show you this pie chart here because that's in fact what it is. So the next slide, you'll see the portfolio pie. The pie is your whole portfolio. And within the portfolio, you're going to have components of what you've invested in. Most broadly speaking, you're going to have stocks and bonds as the main components of your portfolio. And then within stocks and bonds, there's different ways you can diversify a portfolio. Your next slide here, showing the diversification across a couple different crisis periods, shows you what this looks like. And so within the bond component, for example, not all things are equal. And this is why being diversified in the right things really matters. So if you look at the blue line in each of these periods of crisis, those are what are called treasury bonds, bonds from the US government. But if you look at the red line, those are what are called high yield bonds, commonly called junk bonds. They're quite risky in many cases. They are often put in portfolios as diversifiers, except that they really fail to diversify. And what you see here is both in 2008 and 2020, you can see how these high yield bonds, supposedly a diversifying, safer part of a portfolio, went down right as stocks were going down and did so in almost correlated fashion, right? So what you put in the portfolio pie really matters, okay? In these two instances, had your bonds been treasury bonds instead, you would have had something in your portfolio helping you out during those crisis periods. All right. Our next slide, within stocks and bonds, you have a bunch of different choices, right? And we call this a quilt, an asset class quilt. And what this shows you is for every single year, the top box is the best performing asset class. The bottom box is the worst performing. And each of these boxes is a different thing. So if you go back and look at 2008, you'll see high yield bonds in the green, cash in yellow, so on and so forth. Next, 2009, emerging markets at the top, high yield next, international stocks next, and so on. The big takeaway of this, is look out at the end. Imagine this graphic went all the way to 2026, and I'm telling you, okay, for 2027, tell me what's going to be the best and rank them from top to bottom, and how many of us are going to get that right? Nobody's going to get that right. This is constantly changing. Nobody can pick next year's best asset class, but what we can do is hold all of them in the correct proportion so that we capture the overall returns of a properly diversified portfolio at low cost. That's the whole idea. All right. Okay, we'll move on to the last main thing that's in our control, and this is investment management costs. This is a biggie. Fees of any type are always a drag on return, and investment management costs are a primary thing that we should pay attention to. And so the question is, true or false, you get what you pay for, right? We hear this a lot when you think about anything you might be buying. And not surprisingly in the investment, or maybe surprisingly, but the answer is false. You do not get what you pay for. Within investments, investment fees are one of the best predictors for future performance, meaning the higher the fee, typically the lower the future performance. And there's decades of evidence that back this up now. All right. So you can see here in the next slide, we got stock exchange, a bunch of traders. And the question, where do the fees go? Well, they don't go to you, unfortunately. It's your money. Unfortunately, the fee doesn't go to you. It's going to, a mutual fund manager, perhaps, or a private equity firm if you're an institutional investor. You name it, it's going elsewhere. All right. Warren Buffett, I don't think he needs any introduction, but you might recall he made a bet. This was back in 2007, where he bet a hedge fund manager that, I think it was a $1 million bet, if I recall, that the S&P 500 index over a 10-year period would beat whatever collection of hedge funds this hedge fund manager, it was Ted Sides, if I recall, was going to take the other side of the bet with. So they put the bet on. This was 2007. Ted Sides put together a portfolio of 5 hedge funds. Hedge funds are supposedly very sophisticated investments that can offer market-beating returns in many circumstances. They charge high fees, et cetera, et cetera. Well, I think you know how the story ends. The S&P 500 index over this 10-year period, it was a 10-year bet, won and won handedly. It wasn't even close. I think the average annual return for the S&P was 7% and change, and the collection of hedge funds was like 2%, which is interesting. And the other interesting point was the bet started just before the global financial crisis and spanned the full global financial crisis and ended 10 years later. And so this is the exact environment that these hedge fund managers and these sort of high fee money managers claim that they can beat indexes, the primary environment they should have performed in, and they did not perform. So the big takeaway is that of types of investments, generally speaking, index tracking investments, low fee, buying the indexes, not in every case, but statistically speaking, gives you the best chance, the highest probability long-term that you're going to do better than all of these other high fee products. That's in your control. You can choose how to invest your money. And so that's a big one. It's not flashy, But if you like taking the best probability bet, which we all should, then that's the way to go. Slide 20 quantifies this and shows you why this is critical. So you can look at this glide path here, or climb rather, of a portfolio that started with $50,000. The assumption is it earns a 7% annual return before fees. And you can look at what total fee burden does to this over time. And if you look at the far right, you'll see 3% total fees, 1.75%, 3/4. Just to give you the most extreme example here, look at the difference between an all-in fee burden of 3/4 and an all-in burden of 3%. And you can see that the 3% fee versus the 0.75 gave up 2/3 of its eventual ending value. I mean, that's a massive amount of loss just to fee drag over that 50-year period. And a 50-year horizon is not unrealistic for someone who starts investing, straight out of college. So that is the big takeaway. It's your money that went elsewhere. All right. And so these are the main things that we can all focus on in terms of producing better portfolios for ourselves, right? Behavior, asset allocation, and fees. If that was the thing that we all spent our time focusing on, we would solve 99% of our problems, and the rest of it is just complexity for complexity's sake, right? So with that, the last part of our presentation here is what we put together. I should give credit where credit's due. Jennifer put together, this was her idea, sort of a series of investing personas. And the idea with these is to highlight different types of people and how their traits may fall into these types of things we've talked about today. We're not trying to make anybody feel called out here. It's just to highlight some common traits that we exhibit. And, at any point in our lives, whether, when you're young or older, whatever, you might be one of these people, and that might change over time as well. So I hope this part is helpful for you. And Jennifer, I'll turn it over to you now.
Okay. Yeah, this is really just meant to bring everything to life. And so sometimes with learning, we can hear something, but to really grasp it and to really make it our own, it's helpful to have some examples and to be able to think it through a bit more. So that's the point. So these personas, there's 3 people that I'm going to introduce you to. And this is like, me, my family, my friends, and everybody I know at some point or another. So this is not like, they're just extreme versions of all of, of lots of people. So the first person we're going to meet is Flashy Freddie. So Freddie he's a high earner. He's got a work hard, play hard mentality. He is always looking for the next big thing. He values new experiences, new toys. He's the life of the party. And people know it. People know that he's got cash and he's going to spend it. So he's got, interesting investing opportunities coming to him all the time, right? Maybe he's had a few big wins and he's searching out for that next big win. So can anyone think of, so we talked about some of the behavioral things that people exhibit. So like confirmation bias, overconfidence, market timing, stock picking, concentration risk. Then we talked about high fees. Can anyone think of where some of Freddie's blind spots might be? Does anyone feel like taking a guess?
Behaviors for sure. Not probably trading off for the long term.
Yeah.
That whole live in the moment. Yeah. And investing, I think this was on another slide. It's it should be boring. Like it's not, have excitement in your life, but not necessarily with your nest egg and with the money that really is important for your life. So Freddie's blind spots, some of the ones that came to mind, like you said, overconfidence, market timing, concentration risk, and fees. So he might fall victim to someone with a really exciting opportunity that charges quite a bit for that opportunity.
Would this be somebody who'd hop on a trend too? Like, is this someone who would be like, Disney's never gone wrong. I want to put it all into like one bucket and,
I mean,
fingers
certainly
crossed. Like, I
yeah.
feel like that's the kind of person that would know a particular company and go all in.
It certainly could be. I mean, this is like this is it, and that's a really interesting point too. Just that, these types of behaviors, it's not always all or nothing. Like I said, I mean, we could all have these things, right? And I've noticed that sometimes when people like somebody has a big win, like maybe they put money in there's some show on and one of the people on this show had put money into one of the online apps that really soared right during COVID. And they had this huge win, right? So then they were like, whoa, I got to do that again, And so then, and they didn't just diligently put their money away, and it ends up costing in the long run. So the next person is Timid Teddy. Call him the bear because he's very conservative. But he works very hard for his money. He doesn't, have full faith in the powers that be, whether that's corporations or the government or the banks or whatever. And he just really wants to have ownership. He wants his money in his control. So this picture of him snuggled up with all of his dollars really is not is not really real. It's a kind of a false sense of security. And I'll tell you why in a second. You might already know. But this person keeps their wealth in cash or low yield savings, waiting for the perfect time, waiting to really feel confident, comfortable, really afraid of market dips, doesn't want to see a dollar taken away. Can't control the price, that whole price of admission that John talked about is the volatility. So anyone have any ideas of what Teddy's blind spot might be?
And not starting early for sure.
That's right. I mean, and sitting on the sidelines, opportunity cost, you're right. Missing that compound growth, missing that time in the market because they're sitting waiting. Another one that comes to mind is inflation. So we all know if we've been to the grocery store in the last 3 years, that stuff costs a lot more now than it did 10 years ago. Well, at least I can definitely notice that. So, and that's because one reason is inflation. Okay. So our dollars don't go as far as they did. So if you are holding all your money in your closet or into your bed or in a low yield savings, the growth of those dollars isn't going to be enough to keep up with inflation. So you're actually effectively losing money, even though your balance isn't going down. So it's draining your portfolio in that way because you're not keeping up with inflation. So you have that perceived sense of safety in the short term, but ultimately it's less money in the long term. So time in the market beats market timing is, Vince, what you were kind of getting to.
Yep.
And our last example is Steady Eddie. So, Steady Eddie, he contributes automatically to his accounts, regardless of the news, doesn't really pay attention. He views volatility as the price of admission, doesn't faze him. He knows that time in the market beats timing the market. And he knows from all of the research that over decades, the account's going to go up if he just leaves it alone. Does anyone want to take a stab at maybe what some of Eddie's blind spots might be? Any of his potential weaknesses?
Well, I think
So this is like,
his weakness might not be doing anything, with his money, or he could potentially grow in another market and he never does anything with it.
so I think what you're saying is close to asset allocation. So if you're not paying any attention, correct me if I'm wrong, but I think what you're saying is if he doesn't pay any attention to it, if just because it's in an account doesn't mean it's working the way he might hope it's working. So just because your money is in a brokerage account, that money could be sitting in cash. So this asset allocation concept, it sounds like tricky, but all it is like knowing what your money's doing, knowing how your money is being put to work. So if he really is like just diligent, putting it into account, God forbid, he just doesn't look and then realizes years later that it's been sitting in like, preservation of capital, some fund that just has like little to no growth, little to no returns. As a young investor, if he had started in his 20s or 30s or whatever, you know, he would hopefully have a significant equity position. And if he really truly hadn't paid attention and just hoped that he was putting it away and it was doing what it was supposed to be doing, he could have missed out on tremendous opportunity and returns. So that's something for Eddie. And also the fees. So if Eddie is just putting his money into like a company 401k, if he literally doesn't look at it at all, he may be in fund selections that are more expensive than he needs. He may be able to choose different funds, different investments for his 401k or for whatever his retirement account is that he has. So, paying attention to how is that money invested and what am I paying for that is really important.
The thing that I notice on this slide is blind spots can also be blind trust. Like in that way, like, I trust that my company or whoever is doing the work for me, and I'm not at a stage in life where I want to pay much attention to this. It's interesting because as you went through these three types of folks, I feel like I have, like, my grandparents lived way into their 80s, and I feel like at different points in time, they were each of these style of investors based on what their life felt like. Somebody in retirement starts to watch those markets a little differently and they get scared when there's those moments of dips and, problem spots, and they start to think that they can take control and make choices that maybe aren't as great. So I think having the trust of who you're working with is really important.
I love
Absolutely.
that. I mean, that's right. It's asset allocation, it's behavioral, those 2 points you just mentioned. John, go ahead.
Yeah, no, those are great points. And I would say one big thing I see quite frequently, and this is just a consequence of our busy lives and setting off in a direction and not having the time really to go back or the interest to go back and look. And this is in 401k or employer plans in particular. I think we can all relate to the experience where you arrive at work and it might be day one, you're briefly told about the 401k plan. And if you're lucky, you have a representative come down and maybe explain a handful of things and give you an election form to choose how much to contribute and what funds to select and so on. And you're just scrambling to get all this done. And next thing you know, it's done. You go on about your career, and it's not till 5 years before you are ready to retire that you go back and look and be like, oh, why did I select this grouping of mutual funds? That probably wasn't ideal. And how come I never, went back and looked at that, right? And so in some respects, that is the Eddie's type of blind spot, is they're so good at set it and forget it that they may not actually go back and look and try to reconsider if the choices were optimal when they made them early on.
And another thing that I've found looking at so many different statements is that they all look pretty good. Like there's a way that that the companies can present your statements and make it look like your money's growing and it's going, so a lot of times people think, okay, it's going in the right direction. Cool. like, okay, but armed with a little bit more knowledge, you can have a little more confidence to actually look and say, okay, what's my breakdown? Where am I in my life? What's my percentage of stocks versus bonds? And how much am I paying? And if you don't see how much you're paying on your statement, you can just look a little bit online and see how much those funds cost, what the expense ratios are. So you can find these things out pretty easily. It's just that most people don't really know even where to start, and it can be overwhelming and intimidating, especially when the statements look so good. They just look nice, and it's generally going in the right direction.
Yep. Yeah, that's a great point, Jennifer. And it's the case. We'll hear these types of comments frequently from well-meaning folks that just aren't armed with this knowledge. And it might be something like, well, I'm doing all right with my stock picks. I've earned 6% a year. I'm making money, right? Is the comment. And so the way to think about that is, could you be making more money for the same risk or less? And if so, then even though you're making money, you're falling behind. And that's the thing. And it's just a matter of volatility in the portfolio. It's a matter of fees. It's a matter of all the things we've talked about today. So it's never enough to just be, quote, making money. Is that good enough relative to the amount of risk you're taking?
Well said. Those are all of my people, but we can take a look at their sort of, just an illustration of what their returns might look like. So if you look at this nice upsloping, pretty ocean blue line, the compound curve, so you can probably guess that's Eddie, just kind of letting it ride, goes up. This one that's kind of going down, you can see the safe but shrinking. So that's Teddy. He's losing money to inflation. And then this real choppy one, you know who that is? That's Freddie. And he's chasing his previous wins. So it's tough to, if you come up from a win like that and you end up here, you're going to chase it, right? So it's just, had he said, okay, great, I got lucky, put it away, who knows where he could be. But anyway, poor Freddie. Takeaways are really from this part is just that your behavior matters. Understand your asset allocation, even just take a step towards understanding it. Just to not have blinders on, and minimize your fees to the extent possible. And I'll let John close with anything else.
Yeah, no, so those are the big takeaways. Thank you, Jennifer. These are the things, again, that are in our control. And you really do want to focus with what's in your control. Saving for retirement is boring. There's nothing exciting about it. And it really shouldn't be exciting. It should be something that is almost like a life habit. For those of you who like to, go to the gym or go for a jog regularly or whatever it is, if you make investing a similar activity and make it part of your lifestyle, stick to these types of things, then you're much more likely to have a higher wealth, much better outcome down the road. And so it's just a matter of making it part of your day-to-day decision making and really sticking with what's in your control. So with that, we can open it up for some Q&A real quick if there's any questions.
There were questions in the chat. I don't know.
Yep,
Katie?
there's one here that says, what is the suggested amount to save to live comfortably in retirement?
That's a good question and a very complicated answer. And what it really comes down to is what your particular lifestyle needs are, your expenses, what you anticipate needing when you do reach that age. And so this type of thing is about financial planning. It's a primary component of what we do. And we always start off with a set of assumptions. So I'm going to give you what will seem like a completely unsatisfactory answer because there's no actual specific number, right? The number relates to to your question, how much should I set aside, right? Well, to answer that, it's how long are you going to be contributing? When will you retire? How long will you live? What is your investment return assumed to be? And so on and so forth. And so with any one of our clients who come in, you might have a starting amount in your portfolio. We know your age. We have some of these assumptions answered that we can hone in on that figure. But when you try to do this, you always want to make sure that you are putting in what I call a margin of safety. And so you never want to assume, oh, I'm going to earn 12% a year on my investments, right? Well, that's totally unrealistic, and it makes all the projections meaningless. And so that is an exercise that we do for people after putting together all of these bits of information to try to hone in on that correct number.
And I would add, maybe you said this and I just missed it, but something else that's just really in our control is how much do you spend? Like, what's your spending? How much do you need to retire? Like, is your how, what are your needs in retirement? What do you think they are? What are your needs now? It's probably going to be pretty similar. So.
Yep. No, that is the key component. That's the lifestyle question is if you have a good handle on what your expenses are now and what they will likely be later, that's a good starting point to then assess based on this amount, based on these cash flow needs when I'm 65, this is what I should have set aside today, assuming it grows at such and such rate of return. That's the way to approach it.
It's funny, I think of people in the sort of like 40s, 50s age bracket who are dealing with, family members getting older and what that might look like and what it looks like to have to either help support those elderly family members or an expectation on the other end that something will be left for them, either to clean up or to help sell a property and or how those finances trickle around a family. What does that look like for people in terms of like how do you handle that? I guess would be like the greatest question, because I think everybody has those moments, right? Of either a windfall or oh man, I gotta help out in a way I wasn't expecting. How do you plan for those things?
That's a great question. And that is the key reason why anytime we do financial planning, I like to put in a margin of safety in the projections. Is life being what it is, we will all experience surprises. With a margin of safety, what you're trying to build in is a way to deal with, let's call a costly surprise, right? Costly surprise might be an ill family member you have to take care of and you need to support them financially, or anything of that nature. It wasn't on your radar and now it is. A positive surprise will be, like you mentioned, Katie, a windfall, right? Some inheritance or something that happened that you weren't expecting. And okay, great. Those are much easier to deal with. If your financial plan didn't depend on the windfall, then any part of that windfall that comes at you is call it bonus money. You can reconfigure the plan from that point forward, knowing that that's now part of the picture. It's the other part that's really key in making sure you have that margin of safety. And so any good financial plan, if in your expense picture moving forward, you really ought to include what I would call like shocks to your timeline. And those shocks will be something like an emergency spend of some sort. And so you can literally do that in the plan and say, okay, what does it look like if I have to come up with X amount of dollars in 2050 or pick a year, whatever it is. And you can sort of stress your plan to say what if, and that's building in that margin of safety to deal with that. If you don't put those in a financial plan, Murphy's Law, something's going to come along that will will be that. And if you haven't accounted for it, then that's where you start to run into trouble.
Thank you.
Yeah.
That's helpful. Anybody else have any thoughts,
Yeah.
questions?
Was there anything else in the chat?
No.
Okay.
A little bit about that. The comparison on the fees is really wild to see that curve is
Right?
was a comment for sure.
I
Yeah.
know, like 1%, like if you told me something was 1% cheaper, it's not going to, generally it's not going to move the needle, right? But on your investments, that compounding, it's insane.
Yep. Yeah. And if you think about, when you think about fees, if you think about the fee as a percentage of your return, so imagine if your return absent the fee is 10%, but with a 1% fee of course is 9%. You've reduced your 10% return by 10% a year, right?
Exactly.
So what seems like a trivial amount of money is over years and years and years, it's a compounding effect where the initial amounts that would have been in your account are gone. And so those amounts can't grow themselves. And then over time, you see exactly what happens in this chart is those lines start to diverge and diverge significantly the longer you go. And so those are your dollars, absolutely. And so minimizing fees, whether it's investments, whether it's your advisor fee, fees of any level, to keep them low, and they better have a purpose, right? They better do something for you is the primary thing.
Jennifer, I wanted to thank you for something that you had said about grace for previous choices.
Don't
Because
I know about that?
I think back to some of the choices I made in my early years. I was, able to have a 401k through my workplace at the time. And, I got myself into some credit card snafus. And I pulled from that account just thinking that that was like an extra savings account. Like, I don't think I had the wherewithal to really understand some of these pieces. What is your best advice for folks who have kids, heading off to college or coming into the workforce and really explaining the pieces of what this means to young folks and when not to grab
So,
from it?
and when not to grab from it. So there are so many different options out there, and like a lot of these questions, like it depends on the family, of course, it depends on the kid. I know, Roth, if the child is, if the kid is a young adult and they're able to work, you can create a Roth, custodial Roth IRA for them. And then I think with kids personally, just helping them establish the habits and helping them to that's really it. Just helping them to establish the habits where if they're not making much, at least they're putting something into some account, right? So it can be another account you could open for your child as a custodial brokerage account. That, I'm not suggesting it. I'm just saying if your kid is, really interested in the market and they want to they want their money to go somewhere else rather than just a bank account, that's an option. You can do that. But I think really I think teaching kids the behavioral part is, we talk about it too much, my poor kids at home, but we talk about it too much at my house, right? But like, just, I think the importance of avoiding debt, because I think the credit card companies and everyone else, they make so much money off of us opening that card. You save 20% when you open the card at any store you go to, right? But because they make so much money on it. Even if your intentions are good, you're going to pay it off. Credit cards aren't for everybody. So I think really driving home the lessons, like what you said, just avoiding debt in the first place and creating good habits. Some people say 15% of your income is a nice amount to save for retirement. But again, to John's point, there's no right or wrong, and it depends. So, maybe starting with some amount is a good idea, but habits and avoiding debt, I would say, are my biggest ones for kids.
Yep, the financial literacy piece is a huge deal. I certainly hope it's gotten better than from when I was in school. I think, we can all relate to about the only thing you were taught was how to balance a checkbook. There was no discussion of loans, interest rates, credit cards, anything like that that were the big whammies when you got right out of school. And in college, they were handing out credit cards like T-shirts, right? So yeah, you learn along the way through experience, unfortunately. And so for anybody with children that can provide that head start from a literacy standpoint of just the nuts and bolts of loans and credit cards and investments, so that the language isn't so bizarre, and there's a base level of understanding, it can hopefully help steer some better choices, because we've all made those mistakes, every one of us. And the idea is to minimize them as best as possible.
Thank you.
John,
Anybody else
I've
have
got the
anything?
last.
Oh, sorry. I just wanted to see if
No,
there was another one. Go right ahead, Jennifer.
no. That's all.
I was wondering if anybody else had any thoughts or questions as we get towards wrapping things up. Ella, hop in there.
Hi, thank you. Um, so I appreciated the presentation, and I'm gonna make husband watch it when he gets home from work. And so it's good it's recorded. And so I've been all three of those people. And so now I need to be the boring person and just put it away and forget about it, and I don't know, I came into small business late in life, so like I've been surviving, and I need the grace on myself. So it's good to hear that, and to just keep plugging away. I am working with a local whatever company, so it's helping, and but this just like reiterates it, so it's good for me to see. And then the last bit, as an artist, I've made those squiggle lines like topographic maps for years. And so I just did more now on my mini iPad. So I appreciate that. It fed my artistic self. Thank you.
We love it. Thank you, Ella.
Yeah, it's simple, but it's not easy, right, John? Investing, it should be boring, but it doesn't mean it's easy. It's not easy. But
That's
anyway,
true.
thank
That is
you.
true.
Thank you, Ella.
Well, thanks, everybody. This was really, really insightful to the folks at One Day in July, both John and Jennifer. We appreciate the insights. In conversations like this, I'm always thinking to myself, if I could just go back in time and be 28 all over again, or 25, and would do a lot
I
of
know.
things. But hopefully I can pass this knowledge on to my son, so that he can, know the things that I didn't know at that age. So we're off to a good start. And I do want to give a shout out to our series sponsor, Florence Bank, who is our official sponsor for the Lincoln Learn series that makes these programs completely free and open to the public. They believe that a well-informed community is a thriving and vibrant community. So through the chamber, they support this program, and we are able to bring it without cost or charge to anyone who wants to come. And as was noted earlier, we do have all of our previous sessions archived online. This one will be included in that library. So thanks again to One Day in July. And as when folks come looking for financial advisor, now you're on everybody's radar, and we'll make the referrals as appropriate. So thank you.
Thank you, Vince, very much. And I also want to thank everybody at the Greater Northampton Chamber of Commerce, and Northampton community in general. The being here. We've been welcomed. It's been a fantastic place to be, and we're really excited to be here in town. And so we love the educational component of what we do and why we wanted to jump on this type of discussion. And you all facilitated it, and we're eager to do so. So thank you all very much. Apologies again for any technical snafus today, and hope it was still delivered okay for everybody out there. So thank you all for your time today.